We are talking about sustainable finance. And I welcome Thomas Marlitz, Vice President, Regulatory Compliance, BFS Finance. So the EU is setting the pace for the development towards sustainable financing models with the Green Deal. Interacting with this, investors, banks and insurance companies are moving their assets to sustainable finance models, and that's challenging enough. So we are curious to hear your insights, so up to you. Thank you.
Thank you, Robert. I'm very happy to share some ideas, some thoughts about sustainable finance in the financial institutions industry, specifically as we have a lot of listeners out of this world in the factoring and leasing industry, as we are facing some specific challenges based on the sustainable finance. Let me just leave some words on the BFS Finance. As you probably know, BFS Finance is the factoring company within the media group of Bertelsmann in Gütersloh. Bertelsmann is probably today the oldest company on board, was founded 1835. Greetings to the colleagues from Wehrhahn we heard earlier on. And BFS Finance is offering factoring and central regulation since almost the early 60s. So it's a well-established player in the market, in the B2B factoring market. So let me first put some expectations right. I won't have any answers for you. I won't have any solutions for you. And on the other side, we have numerous unresolved questions, and we have even more open answers. So what I want to achieve is to give you, in the first place, a kind of overlook, the big picture, what is going on in the world outside, where does it all come from? And in the second part, some challenges we are facing in the industry in the next couple of years, starting not today, but has already started. So where does it all come from? What's the basis of all that? What is the source of all it? And we look back to the year 2015, where we had two big results. The first one was the UN resolution about the Sustainable Development Agenda 2030 with the 17 sustainable goals, which you probably know, which come more and more in the foreground in the last couple of months and years. And secondly, even more present, 2015, the Paris Climate Protocol, followed by the Glasgow Conference just a couple of weeks ahead. These two main drivers, the ESG goals by the UN and the Paris Climate Protocol resulting from it, are the main basis for all thoughts about sustainable finance. So if you go back one level lower to the EU level, I know that we have some listeners from outside the EU, but as the EU is one of the main drivers in the world economy, I think that will impact other economic areas as well. And we look back to the year 2019, the European Green Deal, at that time published by Ursula von der Leyen, sometimes laughed about, not taken really serious at that time. But in the background, kind of hidden behind COVID-19, a lot of things happened, and the EU Commission published just in March this year consultation papers on the regulatory framework of sustainable finance, and just in July, a couple of weeks ago, the Fit for 55 program, which detailed the recommendations from the European Green Deal. So we see, coming from an UN level to the EU and into the single economic areas, there's a lot of things are going on. There's a lot of pressure from the political side, from the regulatory side, and we see the outcome. I call it today's picture. We see actually already things happening outside there, which are interesting for us. I first want to put the attention to a company called BlackRock. You all know BlackRock as one of the major investors in the world. And if you go to their website and to their publications, the central message is the tectonic shift to sustainable investing. So what's happening? BlackRock is shifting its investments into sustainable assets and sustainable investments, which means that as BlackRock is stakeholder of thousands of large companies all around the world, BlackRock is moving and pushing companies, investors, asset managers to invest into more sustainable assets and investments. Why are they doing that? They are not the good guys. They are not the guys who say, oh, we want to change the world. They want to earn more money, and they have realized that the earnings are better in sustainable financing than in non-sustainable financing. So that's a major shift which is happening in the last couple of months, probably the last 2 years, which probably has already an outcome when you see announcements from large industrial insurers like Allianz or AXA, who have announced a couple of weeks ago that they want to get out of ESG, not compatible ESG investments like coal, like oil, like sand business, which is fairly interesting because if an insurer wants to move out of a given industry, that has consequences. And if you look at Allianz, mother company of the credit insurance company Euler Hermes, it will be very interesting to see how the credit insurance industry reacts on that, what happens with credit limits on oil industry, what happens with credit insurance for the coal industry, for suppliers of the coal industry. That will be very interesting and very carefully to watch what's happening there because it will affect our business in the factoring and leasing industry. Another major step was the, you already know it, the court ruling from the Netherlands against Shell. Legally, I'm a lawyer from the background, so I find it very interesting. I think first time that a court actually moved a company to change their strategy, to change their economical goals. What did they say? They said, basically, Shell, you are doing a lot for the climate protection, to change climate, to become climate neutral, but it's not enough. You have to do more, and we as a court, as a small business court in the Netherlands, we order you to do so. And if you think about it, that's quite hefty, that's quite big. And we already see, at least in Germany and in some other EU countries, that interested groups, ESG groups, are preparing similar court rulings against other companies, especially the automotive industry and the chemical industry. And the last thing, the European Banking Authority consults on ESG risk papers for the financial industry. That's also an outcome of this big picture. So when we take all these information, all these movements, we can see behind the shadows of the COVID-19 time, the question is, what is sustainable finance at the end? And if you look to the EBA action plan or the EU taxonomy, which was published this year, we find two main parts of a sustainable finance definition. First of all, sustainable finance can be broadly understood as financing arrangements that contribute to the achievement of strong, sustainable, balanced, and inclusive growth. So that's the ESG part in it. And the second part, which is more an operational, and that's where we all come into the game, says sustainable finance also refers to the process of taking due account of environmental and social considerations in investment decision making. So now we are in the game. We are part of the game. Investment decision making. We have to decide credit limits. We have to decide about leasing assets and so on. And that's a link from the big picture, from the UN sustainable goals to our daily business in the future. So let's have a look at some challenges we are facing from that. I think basically we can see three interacting risk categories coming out of this transition period: physical risk, transition risk, and legal and regulatory risk. And if we look a little bit deeper into it, we can see if you talk about physical risk, we all have seen that the last couple of months we are realizing a new number of hazards in this world, and we have to think about how does this affect our clients, our assets in which we have invested into. We need a further valuation of these physical risks when we decide about a new company, about a new asset investment, and so on. The second part is the transition risk. The fight against climate change leads to transition risk, leads to transition, and out of this transition come a lot of risk. Just a few examples. What about the carbon bubble? What has been balanced on the balance sheet, and what's the value of tomorrow when carbon is not valuable anymore? Coming out of cost risk, what happens with our clients, with our assets? Right at the moment, we see a sharp rise in carbon dioxide pricing. We see a sharp rise in energy pricing. What does that with our customers and with our clients? And at the end, market risk. What does this risk do with our clients? What will our clients do? Will they change their strategies? Will they change their markets? Will they change their approach? And that has effect on our investments, on the factoring, and especially in the long run in the leasing business. So and finally, legal and regulatory risks. We see a lot of movement on the legislative side. We have seen in Germany the supply chain legislation will start 23, and we see this afternoon from the Schumann colleague Schwager a short presentation on the Lieferkettengesetz, which pays on this. But this goes in any country. The legislator is moving fast forward to transform the economy into a climate neutral economy by the way of legislation. And that puts more regulatory requirements to the investors, but also to us as a factoring and receivable finance and leasing industry. We see that every day, and especially in Germany, we are facing new regulation by BaFin by next year, which has already been announced. And finally, if you put everything together, we are facing more and more reputational risk connected with even stronger social media. What happens if we invest in an industry where we probably under ESG aspects shouldn't have invested in that way or without mitigating these risks? So we see from moving the economy, moving the financial industry into a more ESG-friendly environment, we are facing, on one side, a lot of risks, which we have to face, which we have to evaluate, and which are new. So far, when we look at clients, at assets, we look as a bank. Traditionally, we say, oh, the client can pay it, the client is good for this investment, and so on. We probably look at fraud, we look at dilution in the factoring world. But this is a new category, a third category beside the credit and the fraud category, which we are already facing. So that brings us to a lot of requirements, additional requirements in our organization, but also in our IT world. So let's move to the next step and see what is, for our industry specifically, below the international picture, the main drivers. What are the main transition drivers? And again, we can see three main pillars in it. The first one are, as already mentioned, the investors. The example is BlackRock. They are pushing us very hardly. Then from the other side, EU and national regulation comes. Based on that investors movement, but they are interacting very heavily. And I think that's one of the major drivers and the major aspects of this whole change, corporate culture. So corporate culture, what does it mean? What is the impact on corporate culture on the ESG discussion? So far, corporate culture was more a kind of a background discussion in many companies, how we govern the company, how we deal with works council and so on. But the new question is sustainability a corporate value? Is that something behind our companies, behind our groups that we want to stand for? And the next question is then, if you say, yes, it is a corporate value, is sustainability a part of the corporate culture? Yes, I think it should be, because without the corporate culture, without the sustainability as part of it, a company can't act and can't move forward. And what are the chances including sustainability into the corporate culture? I think they are huge, and they are massive, and they are necessary. Let me put it on one example on the HR, on the human resources department. When you talk to younger people, not my age, but the age of my children, your children in the 20s and in the 30s, when they talk about corporate culture, about corporates, which company I want to work for, sustainability, following the ESG regime, following climate neutrality is one of the major aspects to choose a company. And today we are living in a world where young people can say, I want to work for A or for B. I can choose. And sustainability, ESG criteria is one of the major aspects to choose a company for the younger generation. On one side, and on the other side, this younger generation in the future is our customer, our client. So we have to take care of them, and we see, let me allow that, just the German elections showed that the young people are electing the Green Party and liberals who are forcing this movement. So I'm running a little bit out of time, therefore I want to focus on just two more aspects, two more transition drivers. The second one, the first one, I think the corporate culture is the main one. And then from the outside, from the legislator and from the regulator, comes regulation. And the good news is that this regulation, this transition to sustainable regulation follows known footsteps. The regulator asked in the first place, like in many regulational areas, for a sustainable finance strategy. What do we want to achieve as a company? What are our goals as a company on the sustainable finance field? And then the next step, we all know that coming from the regulatory world, out of the strategies, which risks do I have? Which risks do I have to take care of? And then I think this is a key factor talking about the changes and the challenges we are facing, comes the subject of risk classification. If we say we want to focus on ESG focused companies, not only, but we want to face on it. And then on a client level, probably on an asset level, probably in the far future on a data level in the factoring, we have to classify them. We have to see, okay, company A is in the coal industry, and under ESG aspects, this is probably more a minus than a plus. But then on the other side, we probably have someone working in the solar industry. Under ESG aspects, it's more a plus. To do so, we need information, and we need a ESG rating coming out of this information. And that's vital. And that's one of the key points we have to face in the factoring, leasing, receivables finance industry, because we are usually dealing with small and medium-sized companies which are not having any own ESG ratings, which don't have any public information available for that. So that's one of the major challenges we are facing, getting this ESG rating. And the next steps are known as well: risk mitigation, supervising, reporting. We all know that. We just put a new headline on it. And let me, as Robert is already coming to the stage and asking me to force, and I don't want to break shorten your break, have a last look on the investor side, who are financing our portfolios, our leasing assets. And investors today look not only for profitable, that's already known, that happened for the last 200 years, but newly also for sustainable financial investments. So the allocation of funds will therefore follow sustainable criteria and clients. And again, if you think this thought to the end, we come to a classification of our clients, a classification of our customers, and we are looking for a ESG rating which in the future will have the same value, the same power as the normal credit ratings we already know. So putting all things together, we are facing huge changes. The changes are already there. We can discuss about climate change, yes or no, but it doesn't matter. We have to face them. The regulator will force the industry, leasing, factoring, the financial industry, to more sustainable financing, to more sustainable clients, to more sustainable assets. And this change will challenge us, but with given instruments, with the given structures we already know in our industry, I think we can face it and we can manage it. So, at the final end, please put your questions into the chat. and Robert will pick them up for me. And thank you very much for your attention. Thank you.
Yeah, so thank you very much for this excellent overview. So you see in our conference we are not focusing on a very limited view regarding credit risk. So we have a broader view. There's a comprehensiveness doing business, especially in financial services. And maybe one question out of the chat. What about the costs? What about the additional costs covering all these requirements and to put that into a strategy?
Yeah.
So maybe if you could give an estimation, what is your view? What is to do to handle costs?
Yes, let me put it in 2 points. The first one, ESG doesn't care about costs.
Right.
The second thing, we have to take care of costs. Of course, as a company, we have to earn money. But I think if you look at the chances moving a business model into more ESG-friendly investments and ESG-friendly markets, then I think the chances are very big. Mm-hmm. And I think the values we can create out of this shift are much bigger than the costs to make us or to put us in a situation that we actually can handle it. I think the chances are there. Mm-hmm. We have to pick them up, and we have also, I think, to shift our thinking from the cost aspect, to a kind of generation aspect. Mm-hmm. As on the human resources side, if you want to hire people and you say ESG, that's too expensive for me. Mm-hmm. And another company says ESG, that's our goal, that's our market. Where will the young people go to? Yeah. And I think this has to be much more important. And then the earnings at the end will prove that this strategy is right.
Yeah, so what a great final word before the break. So that it's more the positive outlook and the challenges, of course, on the one hand, and the opportunities on the other hand. Yeah. That's exactly what the spirit of the conference is, not looking only to the negative side of risk. We would also cover the opportunities based on that. Yeah. And of course, that is really important. Sustainable finance, a great topic here. So thank you very much.